I know I do. It's one of the things that attracted me to the whole strategy. Okay, let's do a little anatomy of a bought strangle, just some of the key components of, or factors, I suppose, that make it up. Now, it's a volatile option strategy, which means it runs basically on volatility. Volatility needs to be low at the time you enter, and you'd want it to be high at the time you exit to get maximum profit. It's a debit strategy. In other words, it costs you to put this on, but at the same time, whatever it costs you to put on is the maximum you can lose. Love it. So basically you buy an out of the money call, and we're buying an out of the money put. Your maximum profit is unlimited. That is just fantastic. And your maximum loss is limited. It breaks to the cost of the strangle. So, you've got to love it. Now we've got another key component of the strangle is the break-evens, and you must work these out prior to entering to see whether the trade has viability or not. So your upper break-even is your strike price of your call plus the debit plus the cost plus the cost of the strangle, and your lower break-even is the price of your put minus the debit. And I'll show you in a sec how you draw them on the chart to see exactly where the range is, to see whether it's a viable trade or not, whether you think that stock is going to, go within those ranges. You don't want it to go sideways. You don't want it to be, bouncing through here. You want it to be up to here or down to here. You need it to hit those levels and hit them comfortably for the strategy to be profitable. Okay, so here's some advantages of a strangle. You can profit whether the share price rises or falls, which is a big bonus. You have unlimited profit if a share price continues to move higher or lower. So, because especially if you roll out, like I will suggest that you do, and roll it out and up, or roll it out and down to whichever's the profit, the put or the call, you're going to always be in the market and always take advantage of whichever way the market moves. And so since the trade is non-directional, your outlook can be wrong and profits can still be made. So even if you're looking at a chart and you think, oh, this stock's in a, it's in a consolidation pattern, and you think it's going to break to the upside, and you put a strangle on and instead it breaks to the downside, do you think you're going to care? No. You're hedged. You don't care. You're looking, woohoo, I'm still good. And that's great. Your maximum loss is limited to the cost of entry, which is a very, very good component of this strategy. And if volatility is low at the time of entry, which I suggest it always has to be, and it rises, profits can be achieved without a gain in the stock price. So if you get in at the right time and the volatility is low, and I'm going to show you shortly how to identify the volatility and make sure it's low, then even if the stock just moves a little and all of a sudden the volatility in the market increases, you can still make a profit even if it doesn't move, which is great. Now, of course, I can't do the advantages without doing the disadvantages, because we don't like to be biased about anything. It is possible to lose more money than just buying a put or call outright, and it is, but at the same time, it's only possible to lose more money because you don't have the cost of the other call or put, and you don't have the extra brokerage. But in saying that, you're also losing because you're not hedged. I would much rather spend a little extra money and be hedged both ways than have the thing go up and you lose money outright if you buy a put, or you buy a call and the stock drops. So, in my opinion, this is pretty much, the advantage far outweighs that disadvantage. So, and if the stock price rises or falls but remains within the break-evens, which I spoke about just before, the time decay can eat away at the position, causing a loss. So, in other words, if your break-evens are, say, between this line and this line, and the stock, keeps bouncing around here for the whole month, then the time decay on those bought options can, result in loss of some of your initial entry. But what I do generally is I give the stock about 2 to 3 weeks to move. If it doesn't, then I either reevaluate the trade and think, well, is it still, is my view still that it's going to break out somewhere, or is it just better to close the whole position and move on to another trade that could be potentially more profitable? So I mean, losses are not out of the question. You cannot. Anybody that says that you can trade and avoid losses altogether is lying to you, because you need to take those losses with the good. But if you cut them short and have a plan of what you're going to do, and get back some of your money, then it's not a total loss, and you live to trade another day. So just keep that in mind. And if the volatility falls, it's called a volatility crush. In either option, a loss can occur even if the stock price does not move. So this is why entering with volatility being low is vitally important. Now, here we're going to talk a little bit about the option Greeks. Now, going into too much detail about the option Greeks in this tutorial is beyond the scope of this tutorial. So I suggest you look up, open Google and type in option Greeks and learn a bit more about exactly how they work. Now, this is a delta neutral trade. The delta of the strategy starts off neutral, then increases or decreases depending on the price direction. It's not a big deal, but it's just something you should know. Now, this one is more important, the Vega, which is volatility. Now, the Vega should be low when entering the position to ensure option prices rise when the stock rises or falls. So this is a vital component, and you really need to know what the Vega is, or the volatility. Make sure the volatility is low when you enter. And the last one that is equally as important is time decay. And the time decay has a negative impact on the bought strangles, just as it does buying calls or puts on their own, because you're buying a depreciating asset, so to speak. So you need to keep an eye on that, and you need to not buy strangles with less than 30 days to go, unless you're doing a rollout. I have done it with rollouts to take advantage of quick moves after, especially if it's only happened within a week. I will do that, but as time goes on, if it's 2.5 weeks into the trade, and I'm going to roll out, well then I'll roll out to the next month. The thing with rolling out too far in advance is that the option prices are more expensive, so you don't get, I suppose, you might be in profit when you sell the whole one side of the trade, but then to buy the put or the call again could be cost you a lot more. So you have to decide whether you still think that the trade's got more move in it, or whether you just want to close it out and take your money and run.